Your Lending Era, the podcast where we dive into the world of residential, business and commercial finance, bringing you expert insight, tips and strategies to help you navigate the intricate landscape of lending in Australia. I'm one of your hosts, Jessica, and in today's episode we're going to chat about a fun little term within the finance world, which is the 5 C's of credit. Here with me today, we have Trilogy Funding's Managing Director, David Thomas.
Hey, Jess.
Hey, Dave. How are you today?
Good.
You ready to go?
Ready for another week. This is an interesting one, this one. I like it.
It is. And we also have financial strategist, Hope Westbury.
Jessie G, what's going on?
Oh, not too much. I'm quite excited about this one because, look, it's not so much, policy and matrix and you need to do this. This is just almost a big banner of common sense, which is where I like to live.
Yeah, it is. And this is something that, usually when you explain to clients, they get it really easily. You talk to clients about, credit policies and you talk to them about servicing calculators and loan-to-value ratios and they just kind of glaze over sometimes. Yeah. But this is just really simple to follow.
Yeah. Yeah, and it's a good piece of advice and a good statement, I'd say, to kind of keep in the back of your mind when you're looking at residential, commercial finance, but as well as just personal finance and kind of your everyday operation.
Yeah, I feel like just lending in general, they can relate back to this and go, oh, okay, that makes sense.
Yeah, Absolutely. It's kind of common sense 101. And because I've been doing this forever, I get clients that repeat this back to me.
Oh, yeah.
And say, I've got this, and this. And you're like, oh, cool. All right. Well, they've kind of, it's sunk in so much that it becomes part of their just knowledge base.
Yeah, absolutely. And as you've just said, you've been doing this for a long time. You definitely, I've called you the dad of Trilogy before. You definitely are. But we won't go into what the 5 C's are just yet. We'll keep you waiting a little longer. But let's just talk about why some of these attributes that we're about to discuss are so critical to a lender.
Look, where they come down to is this is, you need to have all of these 5 things in every loan application, and it's inescapable. So when your loan application just goes into the bank, they look at each one of these things for every single loan application. It forms part of what every lender does, right? So this is the foundation of getting loans approved, okay? So if you can't do this, then you're never going to get your loans approved.
Yeah. Okay, well, with that in mind, let's jump straight in. So we'll start off with the first of the 5 C's, which is the character.
So character is a bit of a broad one, and because Dave is so experienced in the 5 C's of credit, he'll back onto this. But just to sort of keep it super simple for everyone that's listening, essentially it relates to your credit history. Yeah. So the inquiries that are on your credit file, the personal debts and liabilities that you have. We like to tell our clients that maybe 1 to 2 credit inquiries on your credit file every year is okay. Yeah. If somebody bought us a credit file that had 20 or more inquiries over a 5-year period, that's probably starting to look a little bit busy. And your credit score is probably going to start to be impacted if we've got 20 or more. In saying that though, and Dave can follow on in a sec, once you have purchased your home, once you've got your offset account set up, once you've got your credit card all linked and everything's set and forget, you shouldn't really need to be making any credit inquiries once that's all settled.
Yeah.
Yeah, correct. So and nowadays with the credit files, they're so much more detailed than what they used to be. So, when I first started doing this, your credit file had every inquiry that you had within a kind of 7-year period, and after the 7 years, they would drop off, right? So it was a really kind of simple document. Nowadays with open data, it contains every active account that you have, right? And with the open data reporting system, the open files that you have or the open facilities that you have report back to the credit agency on a monthly basis.
Yeah.
Yeah. So you can literally see every single facility and if a payment is being made every month for that facility. And it comes up in a little chart and it's like green ticks is what you want to see.
Yeah. It's blatantly obvious.
It is. And some lenders now don't even ask for credit card statements, car loan statements, because they are that reliant on open data, because it is that accurate. They actually don't need to see your statements, because they can look at the credit file on open data and see when those repayments have been made and if they've been made on time.
Yeah, absolutely. And on the back of that, there's also a part of an application, for example, that a broker would have to acknowledge, still obviously verifying every single one of your liabilities, because we've got to disclose if there are any issues that aren't reported. And likewise, we've got a tick to say, yes, we've confirmed this all matches up. They've made every repayment. We can see it. So even, if there is any shortcomings on the credit file, it's still triple handled and verified by us, the bank, yourself with self-disclosure, all of those things, isn't it?
Yeah, correct. And other things that can be on your credit file are probably defaults. You probably know a little bit more about the default aspect than I do.
Yeah.
What can you and can't you get away with?
Yeah, so with a default, guys, some lenders are okay with them as long as they're paid in under, say, $500. However, if there's a default that, went on from a telco 2 or 3 years ago for a couple of $1,000s left unpaid, that will be on your credit file, visible to the lender for 7 years.
Yeah,
so you really need to get it paid. And then if you do the right thing and pay the money back, then after 5 years, that default will drop off. And it can just help, go to a mainstream lender. There are other lenders, they're called non-conforming lenders, that will still look at it as long as it's paid. But then your interest rate's like 1% to 2% higher, and it just opens up.
It's not attractive.
It's not in your best interest either. So pay your bills. Get a look at your credit file, see if anything's outstanding, get it sorted. And there are really good credit repair companies out there too that can actually help. As long as it's paid, they can help get those defaults removed.
Yeah. It's got to be a bit of a backstory to it. You can't just say, I refuse to pay this for 5 years and now I want a home loan.
Yeah.
It's usually a story in line of, there was a dispute over the services that were being provided by the telco or by the service provider, and, there was a bit of a backstory, and then off you go to
mutually agreed fault.
Yeah, correct.
Probably one of the most common ones that I see is like, I changed address, I moved house, and it was just like an electricity bill for $300 left outstanding. The last one, the disconnection fee or whatever it may be. That is the most common one.
And under this character one as well, I want to just touch base on the difference in types of inquiries, because I know that we have clients who come in and they say, there's only been 10 inquiries in the last 5 years. But what those inquiries are will dictate the severity of the issue if a lender does have a problem, won't it?
Yeah, it will.
Yeah, so, and if you think about it in these terms, I've got clients that have, 18 or 20 inquiries over that period of time, but they're professional property investors, right? They might have 6 or 7 properties. They've done, one refinance every year and maybe a top-up or an equity release, or, they've taken out money to do renovations or build a new, investment property. And that all makes sense to a lender, right? So busy credit file, but all for good stuff, all for good debt.
Growing wealth,
right? And then you've got other clients that,
are not at big dog status.
But they're a little bit younger, and they've had car loans, and they've had personal loans, and then they've had, short-term credit facilities that have shown on their credit file. And if you've got 10 or 15 car loans, personal loans, credit cards, and that kind of thing, all within the last 3 or 4 years, you don't look that good to a lender, to be honest.
The lender just looks at it like these people cannot manage their money.
Yeah.
They're clearly not saving because they're continually reaching out for more and more credit.
Yeah.
And it's just not reflective of a strong character.
No, not at all.
And you've got to remember, when do you get a personal loan? You get a personal loan when your expenditure outstripped your income for a period of time. Okay, you did not have the money to buy assets or spending, so you incurred a personal loan.
Yeah.
If you've had 3 of those roll through in the last 5 years, the banks really kind of look at you.
Yeah.
And you remember that some of these banks are looking at 3,000 loan applications a week. If you are that person that has a pretty busy credit file in this kind of bad debt situation, there is 3,000 applications a week, and you're the one that looks a bit, not as good as the rest. Can't be too upset if your loan application doesn't make it through the system.
Yeah, absolutely. And on the back of the character, one that we've touched on quite a bit over the last kind of few episodes is the capacity. Now, what is that one?
So capacity is purely just your ability to repay the loan that you are going for with your current lending commitments and with your current living expenses.
Yeah.
So this comes back to the other things that we chatted about, the debt to income ratio and how a bank's going to look at your specific income, be it self-employed or PAYG, and do you have the ability to show long term that you can service the debt?
Yeah.
Okay. And that's really what capacity is.
Yeah.
Capacity is just a calculation that we do in the back end
Yeah,
to
that's
ensure
right.
it's affordable.
Yeah, the individual bank's calculation for responsible lending is your capacity to repay that loan.
Oh, key term, responsible lending. I like to hear it.
It's just making sure that we're not allowing you to borrow more than
Overcommit.
correct.
Absolutely.
And that your income meets the lender's requirements, if and being able to evidence that income, through the correct documentation, be it PAYG summaries, be it employment letters or pay slips or tax returns, how are we evidencing that income and just putting that in the best possible light. So it doesn't only show that you can service the debt, but you can easily service the debt.
Yeah, you can maintain it.
Yeah.
Okay, so we've done character. So that's kind of the character of you as a person based on your credit file, which is a snapshot in time on that day. The capacity, which is your affordability, your debt to income ratio. Now let's talk a little bit about capital and what that means.
So capital is reflective of your statement of position. So it's how much are you bringing to the transaction. So are you bringing a 20% deposit? Are you bringing a 10% deposit, 5%, whatever it may be? That is the capital.
Okay, so that's kind of what you're actually tipping into the transaction for them to tip in the rest.
And
Yes.
the more that you tip into the transaction, the less the bank's got to tip into the transaction, therefore the less risky it is to the bank.
And the happier the bank will be.
And I think it's fair to say that capital and capacity are kind of the two areas that can improve the others if the others are kind of falling short a wee bit.
Exactly right. So if you maybe do have a bit of a dent on your credit file, but you've come forward with a 30% deposit, the lender's going to go, man, this guy's changed their whole life around.
Yeah.
Like they've really made a comeback, and we're happier to lend to this person on that basis because they're less risk to us.
Yeah, and if you're a self-employed individual, similarly with, a very good statement of position, but you can see maybe last year wasn't the best, but the year before was, that's where they kind of make a few little adjustments to see, okay, well, you're coming back to normal. You've got a great statement of position and you've got the cash flow behind you to succeed.
Yeah.
Correct. And we were chatting about this yesterday in terms of having buckets, right? So imagine there's kind of 5 buckets of your 5 C's. If you've got one bucket that's a bit emptier than the rest, the other ones need to be full, right?
Yeah.
Because it will help compensate between the things that your application is lacking in. If you've got 2 that are really strong elsewhere, then you can have one that's a little bit on the weak side.
You absolutely do not have to have all 5 buckets filled right to the brim. You don't. Some, as Dave said, can be a little bit more empty than others, but we try and look at it from a glass half full perspective. And as you said, Jess, if your statement of position is super strong, then that can help other things.
Yeah, absolutely. Now, off the back of capital, let's chat a little bit about the collateral in this whole scenario.
Yeah. So this is what we are offering to the bank as security. So not all property is equal, right? So even if I said to anyone listening, if you had 2 options of a property as far as what would be good collateral for the bank, and one of them was a studio apartment that was 40 square metres on a main road above a fish and chip shop, and the other one was a 4-bedroom home out in the suburbs that was in a really nice kind of area that owner occupiers and renters loved.
Yeah.
You'd pretty quickly determine which one the bank would like to take more as, security for their loan, right? So this does actually formulate, a relatively big part of your loan application. Not all property is equal. Some property is in areas that has, longer days on market, like, rural for, or mining towns or things like that, that you need to, that security is not the same security as, a metro location.
Yeah.
And we get this all the time with clients. Some lenders might have, lending restrictions for certain postcodes. might have lending restrictions for certain types of property, be it student accommodation or small apartments or, combined, residential and commercial facilities and things like that.
Yeah.
So it's having a look at that property
Yeah.
and, how good a property that is for the bank's security. And if it's not, how do we balance that up? Do we balance it up with more capital? Do we balance it up with, having really strong servicing capabilities to be able to show that we can pay the debt off quicker than normal?
Yeah.
I think this is definitely, of the four, I'd say that collateral is one of the ones that's kind of almost a little bit non-negotiable, because the banks, through their security lending margins, will just kind of put a hard line down saying, yes, you've got this property, you love it, great, but we will only lend you 70% of its value.
The postcode restriction is a big one. So to give you guys an example of what that would look like, Sydney is very high density in some areas, and so there's certain postcodes within Sydney that have a lot of apartments, 1 bed, 1 bath, no car park. Those are pretty hard to resell at times, and so the lender wants to make sure that they aren't overcommitting to anything with properties like that. Yeah,
exactly. And in that collateral sense, that unfortunately, if you do find a property that falls at that kind of level where you do have to chip in a 30% deposit, it'll come into your capital. What can you afford? If you can only afford a 20%, unfortunately, the hard line in the sand is not today on this one.
Yeah, we'll just have to redirect our sense of direction and look at something else.
Yeah. The other thing with the collateral in banking is, out of the other C's that we've discussed, they're all hard and fast facts. Right? You've got a default. You haven't made your payments, or you have made your payments. You earn enough to service the debt. You have enough money to be the required deposit. When it comes to collateral, everyone's home is their castle, right? And everyone's investment is the best investment. So this is the one that I sometimes get a bit of pushback from clients when I go back to the bank. Say, well, your property's in a Category 4 location, and this bank doesn't like it as security, or it's an NRAS property, and this bank doesn't like it as security. And they get a bit outraged about it. And they're like, no, that's...
Take it personally.
They take it personally.
Yeah, absolutely.
None of the other C's you can take personally. But this one you can, and you can't let that cloud your judgment. You have to just rely on the bank's interpretation of the asset that you're providing, because at the end of the day, they're the one that's taking it as security.
Yeah. It's unfortunately the price of admission in this one is... There's thousands of properties for sale every single day. Of those few thousand, there's got to be at least 20 of them that are going to have a specific margin. And you as a buyer just need to be aware that may pop up. And that's where speaking to someone before you do it is valuable.
Yeah, because we can always tell pretty quickly, especially judging off the postcode, when we put it through like a debt servicing calculator, sometimes it can flag it straight away, and then we can sort of stop the chase up front so that you don't get too emotionally invested and say, probably not this one today, and then you can look at something else. Yeah,
exactly. Okay, so on the back of, we've got the character, capacity, capital and collateral. Once we've gotten all four of those buckets full, boxes ticked per se, we move on to the conditions.
So the conditions are things like interest rates, repayments, the amounts of money, responsible lending, and the main one is this suitable and affordable for this person?
Yeah.
Yeah.
Yeah. And I used to have a business development manager who was an old grumpy guy that used to have to look after me for a bank. And he used to quite often, cross this one out and write common sense next to it. Does what you're proposing to the bank, this lending scenario, does it make common sense?
Yeah.
And when you think about it like that, sometimes what you're asking a bank to do doesn't make a whole heap of sense. Yeah. And as I said before, 3,000 transactions a week rolling through. If it doesn't make common sense, the lender's definitely going to push back a little bit on it.
So. Old school, I like it.
Yeah.
Old school. But, and in terms of that, what doesn't make common sense? If you've got, a first-time investor buying in a mining town 3,000 k's away from where they live, and they're trying to borrow at the maximum loan-to-value ratio, and hoping that the rental income will supplement their income so they can continue to live where they live. From a banking point of view, you look at that and go, well, this doesn't really make common sense. That person does not know the ins and outs of where they're investing. They're going to be reliant on the rental income of that particular property to help, fund their lifestyle. Like, this isn't really a transaction that makes a whole lot of common sense from a lender. Probably makes great common sense from the applicant, but not from the lender's point of view. There's too many risks there.
Yeah.
Exactly, and I think we see this a bit, with buyer's agents and things like that. Unfortunately, the bank and the buyer's agents, they don't ever communicate, so they don't know the 10-year plan for this property. It's a snapshot in time for them, isn't it?
Yeah, correct.
Okay, so let's just quickly go over in 5 words or less. So character, credit history. Correct. Capacity is your ability to afford the proposed commitment that you are wanting to undertake.
Mm-hmm.
Capital is your contribution to the scenario. Collateral is the property itself or the security itself. And the conditions right at the end, once everything else is okay, is what you were being offered to end this transaction or partake.
Correct. And you've got to have all 5 in every loan application. Varying degrees, as we discussed before, but all 5 need to be present.
Yeah, beautiful. Okay, well, thank you for joining us today while we did discuss the 5 C's of credit. As always, if you've got any questions at all or would like to kind of check your unique position with any of these items, don't hesitate to get in touch. You can find us at trilogyfunding.com.au. It's a website with a beautiful orange kind of theme to it, isn't it? Every time I say it's got an orange theme, Dave gets the giggles. This is his brand, but he gets the giggles. But anywho, if you did want any advice, feel free to jump on, log an inquiry with us. Anyone from our office is happy to chat at any point. Obviously, you can only get specific advice from David, Hope, Paul and Nicole as part of kind of their role within the business. But if you do have any questions, get in touch. Otherwise, thank you very much for joining us today while we did speak about the 5 C's of credit.
No worries. Thanks, Jess.
Thanks so
guys.
much, Jess. Bye.
We acknowledge the traditional owners and custodians of the land this podcast is being recorded, the Ngunnawal people. We pay our respects to the elders of the Ngunnawal people, both past and present.